Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. Now, there is a massive move that we are seeing overall in the markets, and what we have been trying to develop here is a sense for just how much the markets are being imbalanced by some of the moves that we're seeing within the S&P 500 sector-wise. So for this, let's bring in Todd Sohn, a strategist over at Strategas, also Gavin Fillmore, the Chief Revenue Officer over at Tidal Financial Group. Thank you guys both very much for being here with us. Maybe, Todd, we'll start with you first with regard to just how much we are seeing in this move in the ETF world because of some of the imbalances we're seeing within the marketplace, specifically the S&P 500.
Yeah, Dom, it's a great statement right there. Imbalance is the perfect word. You have the technology sector at an all-time high of about 35% weight within the index. Meanwhile, defensive sectors, staples, healthcare, energy, and utilities are at a all-time low at just 19%. And so while this has benefited passive investors in the ETF universe, you just want to be mindful that you're losing diversification using the S&P as a benchmark over the course of a day-to-day basis. I just want people to be aware of that going forward.
If they are aware of that right now, Todd, we all kind of know that there is a movement right now towards momentum, specifically within technology, communication services. That kind of situation is going to right itself in some ways by this broadening out trade happening. So when can we expect to see, if at all, that broadening out trade really try to balance out what's happening within technology and media overall?
Yeah, I wonder if it's actually occurring outside of the S&P 500 in the sense what I'm talking about is small caps, right? The Russell 2000 IWM ETF just went almost 4 years without making a new all-time high. And since April, right, when the market bottomed out and had a good rally, along with the potency of rate cuts, we've really seen small caps pick up the pace. And so I wonder if you're seeing this broadening happen outside of the large cap space where investors are comfortable with their tech and AI exposure and then seeking other routes to perhaps surround that tech exposure, like small caps or even international too, where you're going to get more of a value tilt going within portfolios.
Gavin, you run and you help run a company that has a lot of I guess, offerings with regard to ETFs and just how much investors can use those different types of ETFs to counterbalance a portfolio. What exactly are you seeing from some of the funds that are on your platform with regard to where the development is happening? What types of funds are being brought to market that are in demand as maybe a ballast or some kind of a counterweight for what's happening within that broader tech trade?
Yeah, so Dom, I think what we're seeing, and we're involved in about 300 ETFs, right? So it's a lot of product of a wide variety. And if Todd's right, and his numbers back him up, which is that, there's more concentration in indices than ever, then I think investors are looking beyond just the, let's call it the VU and chill approach, where you just buy the index in an ETF, which is a great approach. But they're looking for diversification, and they're not finding it within the product or within the index. So they have to look beyond that, right? And what we see across our platform is a lot of interest in almost anything else, right? So obviously the gold trade right now is very topical, very interesting. We've seen a lot of inflows into gold-related income products, actually, that we're involved in. We're seeing a lot of tactical trading on the leverage side around single stocks. But probably more than anything, it's really the play for income that I think everybody has an interest in, especially the retirees of late.
And what type, Gavin, if you don't mind, what type of products do you see on your side of things over at Tidal with regard to addressing some of those income needs or those at least desires for things like defined outcomes or just, maybe the secular demographics in general about what's driving so much of that income orientation towards ETF investing?
Yeah, I think the majority of innovation has come out of the derivative space, right? And this is not new. This has been around for a few years now, but people keep trying to short it and basically say the income trade's over, right? I think there's been a prediction like that every year. And we just see that the market is suggesting something else, which is the appetite's very, very sticky. So products around income using derivatives is first and foremost. One thing that we do see that's interesting is, I would say, the historic lazier approach, which might be covered calls, are not always the go-to anymore, right? So now we're seeing more sophisticated strategies particularly using active management to diversify their approach to garnering income from these investments and not just capping the upside. So we see just a lot more innovation, a lot more nuance, and that's really driving flows. So Yield Max is a huge success on our platform, about 18 billion in ETFs, primarily around income-driven single stock products. But what's interesting is they're not just using the classic covered call. Instead, they're oftentimes selling call spreads. And that's been a very interesting approach because it unlocks more of the upside. So one of those like classic complaints around covered calls, you're starting to see managers using more advanced techniques.
Okay, Todd, with all of that in mind, what are you seeing from a flow perspective with regard to some of that income orientation that makes you feel as though this is either a trend that is more secular or more long-term in nature, or one that's much more tactical based upon what the environment that we're seeing in the marketplace is? And if so, Todd, why not just do it plain vanilla-wise with certain high-yielding type stocks or sector ETFs as opposed to going towards some of these more defined outcome or derivatives-based strategies for ETFs?
Yeah, I think this is all about access, right? You think about ETFs, they've been bringing access to certain strategies for 30 years now. We started with large cap equities in 93, gold and EM in 2004, and now we have these covered call, the yield max, right? All these option strategies that previously were not available to many investors out there, to the common investor. And so they've been introduced to this entirely new category. And I think some of them, depending on the investor, they may be sitting on a large capital gain from an individual stock or an index product. And so now they're using these covered call type strategies or option premium strategies to perhaps balance out the risk of downside there, right? They'll gain income. Ideally, the volatility on the downside would be a little bit buffered, right? From the covered call, from the option types of strategies. So I think they're just surrounding current holdings along with the access that they get to these ETFs. And it's the same thing with all the other derivative plays out there, or even just gold and crypto, right? The access to these products is so frictionless now. I think that's why you're seeing so much inflows go to all these categories. Really explosive growth over the last 4 to 5 years.
Todd, that explosive growth has been in certain key parts of the market. You had mentioned before this idea of gold or just maybe metals in general, also Bitcoin, cryptocurrencies. How much is the landscape tilting in your research and your kind of strategic view? How much is it tilting towards these alternatives as more of a mainstream type asset? In other words, when can we start seeing some of these so-called alts become normal just for ETF investors overall? It sure seems as though the products are being added at a very quick pace.
Yeah. If you break down category ETF flows, it's cash, precious metals, and then crypto. So they're clearly being adopted by more mainstream. And I think that also goes in hand with the concentration risk that's going on in the US market. Some investors are realizing they have a lot of tech and AI exposure, so they got to differentiate, find uncorrelated assets. So this seems to be the moment when alts are actually coming into the mainstream. The access is there. It's a lower cost than you would normally find. And now it's just a matter of, okay, in what size? Most of the conversations I have and the allocation papers I'll read say 1 to 3 on crypto and 3 to call it 7 on gold. Does that start to increase over time, especially in an environment where yields are flirting with, say, 3.75, 4% more persistently? And if we have a weaker dollar persist, we'll see. But that case is going to be continued to be made after what was a very different regime during the Q era. We're in a much more normalized investing regime, I think, that a lot of us maybe we're not used to, including myself. So that's the case for gold. That's the case for crypto going forward and becoming more dominant players in portfolios.
This new demand, Gavin, is leading towards a lot more product innovation. Your company is one of those firms out there that has been responsible for a lot of ETF managers being able to bring a product to market to address some of those demand concerns and those demand needs. When it comes to your platform at Tidal, just what kind of innovation are you seeing from some of the ETF managers that are being onboarded to your platform? What types of, ETFs are starting to see the most traction in terms of strategies being brought forth? And then which ones, in turn, may or may not be linked in an asset under management type flow situation where those types of ETFs, which kind, are getting more money brought into them as well?
Yeah, so I think this trend has been ongoing probably over almost the last decade, right? And I really go back to active ETFs. So our platform right now is about 85% active ETFs, which is somewhat shocking. But when you look at the flows into active and you look at the new products being brought to market being um, largely active of late, the industry's really changed, right? And I think we've gone from a world of questioning if active ETFs would be adopted to, the ship has sailed. They are definitely in vogue and the asset flows are supporting it. Now, if you're a new entrant to the market, and broadly speaking, that's oftentimes who title's working with, you're looking to differentiate on a product basis, right? You're looking to offer something that hasn't been offered before. So it's active. And now this derivative, the derivative strategy is really becoming very, very popular because essentially they're offering white space to new managers where, you may have asked participants 5, 10 years ago, was there room for more ETF managers? And some folks would have said no, right? The juggernauts had won and eaten everybody's lunch. But that's changed quite dramatically. We have lots of new managers having a lot of success in terms of flows. What is hard to predict is what's going to be hot tomorrow, obviously, right? Nobody has a crystal ball. But I think diversification is important, not just for allocators, but diversification is also important for issuers, right? You want a variety of products that can behave differently in different market dynamics. So, again, I'll go back to the gold point. Over the last couple months, gold felt sleepy for a long time. And then all of a sudden, the price action has been very, very impressive. And then you see asset flows sort of traffic in the space more so as well. So things are always dynamic, things are always changing, but a really diverse suite of product across the industry is great for end investors. They have so much choice.
Gavin, one of the biggest trends or I guess movements within the fund management business and specifically ETFs has been this idea that over the last couple of decades, we've seen spreads narrow, fees kind of compress, and it's brought on a lot so by this idea that passive index tracking investments are able to do things on a much cheaper basis, therefore leaving theoretically more cash in the pockets for investors. As we've seen this big move towards actively managed ETFs, alternative-based products, more use of derivatives instruments to structure products and outcomes, that's also led to what some are observing as an uptick in fees for certain parts of the market with regard to those types of strategies. From a titles perspective, at what point do you kind of look at these fees and say it's worth it to go some of these routes as opposed to just sticking to a passive type instrument where the fees are perhaps even a fraction of what even the low fees for some of these active ETFs are?
Yeah, so I think you're absolutely right? There's no doubt that there was a trend towards compression of fee within the ETF business that was primarily around the passive ETFs. As active ETFs become adopted, they can support a higher fee, right? The workload that actually it takes to support those products is higher. What it does do, though, is it puts pressure on the managers behind those products to perform, right? If you're paying a premium for active management, you should expect performance. So it does put more pressure on the performance metric from the buyer's perspective, and that makes a lot of sense. The reality in what I see is no longer is the way to look at ETF fees just, what has been the standard within the ETF market, but as the products become more sophisticated, again, especially on the derivative side, you start to really compare to other industry, right? What would it cost to get a certain profile or payoff in structured notes? What might it cost to get that level of active management from the hedge fund market? And obviously we see very, very different fees there. So I think the spectrum of fees should be looked at more broadly, not just inside of the ETF business, and really say, okay, if the end user can get very high octane active management from professional investors, why shouldn't you be willing to pay 90 basis points if oftentimes historically you were maybe paying 2 and 20 for the same or similar product in the hedge fund wrapper? So I think there's a lot more tolerance for fee elasticity actually these days.
And Todd, let me bring you back into the discussion here. If this is the scenario and you work for a company at Strategas that helps advise clients with regard to how they invest their money and what they're doing, have you heard any kind of commentary from some of your clients, whether they be high net worth, retail, or even the institutional side of things, that have been maybe a little bit more interested in just how these new types of ETF products, these alternative-based products, function within their overall portfolio, and just what the risk return needs to be for them to be viable for even their clients, the end users?
Yeah, the amount of due diligence conversations we have has definitely increased, right? Because we are out of the simplicity era of ETFs and we are well into the complexity era of ETFs, considering types of strategies out there using options, using leverage, using swaps, all kinds of derivatives. So we definitely have clients who will call and ask, like, okay, what's the deal with whatever new product that's out there? What's going on in this category? Is there any sort of systemic risk, which I don't believe to be a case just yet or out there? But they want to know what's occurring because the pace of these developments, the innovation, the launches that are going on in ETFs is lightning speed. We're talking records here. So there's certainly a lot of interest about what is going on and also just how to surround the core of a portfolio, which has likely been around for a few generations now, depending on a family, and they want to know how to protect that. So certainly knowing the due diligence process and how some of these ETFs may act because they are so new to a lot of folks out there.
All right, and Todd, one more question to you, and then we'll give kind of a similar one over here to Gavin as well. As you look out for the next 3 to 6 months, what exactly do you think is going to be that thing that dominates the ETF conversation in the coming months as we approach a seasonably strong time of the year and into a new calendar year in 2026?
Yeah, I think for ETFs, it's what's going on in the leverage space. That has caught made a lot of eyes pop out in terms of trying to get 3x and 5x type products out the door. And what does it mean? Does it pose a risk to any of the financial markets? It's way too small of a corner, I think, to have that. And then secondly, I'd say more in market impact. Do any sort of the defensive sectors ever get to work again? We think healthcare is kind of interesting because there's been a ton of outflows from that space, and you can play growth and value within that sector. So I would say from the ETFs, the leverage space, and then in the actual markets and how you may want to position, take a look at healthcare. That's worth a shot in our book.
All right, and Gavin, to you, the final word here. What do you think is going to be that big trend to watch for in ETFs? What's going to dominate the conversation over the next couple of quarters?
I actually think it's going to be a return to thematic ETFs, right? I always viewed 2010 to 2020 as kind of the era of thematic ETFs, and then that slowed down post-COVID, kind of went to the derivative trade, which is obviously growing very rapidly, and I expect that to continue to grow. But I think AI has given thematic ETFs a shot in the arm and proven that ETF issuers can have a lot of success when they're bringing first to market themes, right? And we've seen that on our platform with several AI-related ETFs. And I think that's bringing eyeballs back to that space from the issuer perspective. So I would guess a lot of growth there, which has been a little out of favor over the last few years. So that's kind of exciting to see the seedlings on that front.
All right, Gavin Fillmore over at Tidal. Thank you very much, Todd Sohn over Strategas. We appreciate your time as well. Now, we've asked Gavin to stick around for the ETF Edge podcast. You can catch that and all of our other content over at etfedge.cnbc.com. Thanks for watching. We'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.